Let's talk oil and gold. Our guest says that weaker global demand, especially in China, is dragging down commodities and sentiment in that space. He argues that gold looks like the strongest commodity and shows no signs of slowing down. Let's get more from Ben McMillan, Chief Investment Officer at IDX Advisors. Ben, thanks very much indeed for joining us. Really appreciate it. Start off with gold, if you would. Does gold have a decent chance of climbing to new record highs?
Absolutely. I mean, I feel like a bit of a broken record because every time I come on here, I'm talking about gold. But if you look at the hard data, and if you go all the way back to last year when we were talking about gold, it was all about central bank buying. And so what's interesting is this is no longer a shift along the demand curve with gold. We have new buyers coming into the market, which is central banks that are buying up, I mean, more than double the amount annually. And this is every year since COVID. So when we look at that, we're looking at this as a real global flight to safety, and not necessarily geopolitical safety, although that's part of it, but fiat safety. People are looking at how much money the U.S. printed, and gold is the surest way to protect against that. So obviously, gold has come off its highs a little bit. I think we're in a range-bound consolidation here, but I'd be very surprised if we don't see all-time highs at some point in the back half of this year.
The weak U.S. dollar has generally been good for commodities, and of course it tends to be best of all for gold.
Absolutely. And so that's been part of it. I mean, if you look at the dollar index against, a basket of currencies or really any currencies, I mean, we've had a lot of dollar weakness. Now, part of that is we're at kind of the lower end of the multi-year range here. So again, I wouldn't be surprised that just from a technical perspective, we see a little bit of dollar buying. That's going to put a cap, I think, in the near term on gold a little bit. But I think importantly, gold had this exponential run, and a lot of people were worried about, all right, time to take chips off the table, and it's really settling in there. So again, this is telling us that this is, large swaths of new marginal buyers coming into the fore, and they're not looking to sell anytime soon. The question is just how much more do they start buying and when?
The copper market has been distorted, as you know, by the flood of imports into the United States to evade tariffs. Well, what is your outlook for copper broadly?
Yeah, copper is one where, again, structurally long-term, we're very bullish for kind of all the reasons that everybody's talked about, the kind of quote-unquote decarbonization efforts, the, meeting the electrical grid requirements of, AI data centers and things like that, which, again, by any demand estimates are going to be huge in the coming decades. But in the immediate term, this year in particular, we've seen a lot of volatility in copper just in the last couple of months. I think we're going to be, range bound in the back half of this year. A lot obviously depends on China's demand coming back online. As you said, we had a glut of imports coming in, from the supply side. So this year is, I think, a year to be cautious on copper. It's kind of the broader story with commodities in general, but longer term, even going into 2026, 2027, we're constructively very bullish.
We did get a stunning survey from the University of Michigan the other day indicating that we have no hope of opening enough copper mines to even dent demand unless the copper price doubles. It's just not worth it for companies right now with the huge cost of opening a new copper production facility.
No, it is, and that's part of what we've seen over the last couple of years is a lot of the early kind of early exuberance we saw in copper prices last year was kind of the calculations of that. And if you, depending on the conferences that you looked at or folks that were talking, they were saying it can take 10 years to bring a mine online, and there's just nowhere near enough supply. So that's absolutely kind of the driving part of this structural tailwind. But of course, as markets always do, they tend to price in the best news very quickly. We've seen this with .com, we've seen this with Mag 7. Copper, I think, ironically, we were telling one of our clients was talking to us, and they said, I feel like copper is a little bit like Mag 7, back several months ago, and it was kind of on the hockey stick up. But so yes, that's when you look at the long-term demand supply imbalance, it's absolutely structurally bullish. But we think it's going to probably be 2026 before we start to see it really engage to the upside.
And then finally, the oil, this OPEC's massive spare capacity is an overhang over the market. There's no getting away from it.
Yeah, and when we look at oil's another one where, this year, it's, WTI is kind of hovering around that $60 range. I wouldn't be surprised if it finishes the year there. Depending on who you talk to, they think it could be on the lower end of 50, all the way up to 70. Oil is one where it's really going to depend on China demand coming back online. China's just the 800-pound gorilla when it comes to commodities demand kind of across the spectrum, but oil in particular. You started to see OPEC, walk back some of their supply cuts. So, now that said, the flip side is, of course, when you look out longer term in terms of oil, a lot of people are talking about how the U.S. is kind of past peak production. Obviously, you've got geopolitical elements which can cause oil spikes at any point in time. So it's reason to be optimistic in the longer term, but in the back half of this year, oil is another one where we think it's going to be range bound, kind of right around where it is now.
We'd better jump. Thank you very much for joining us, Ben.
Thank you.
Ben McMillan, Chief Investment Officer at IDX Advisors.